The three Mapletree REITs have just announced their results. Mapletree Logistics Trust and Mapletree Pan-Asia Commercial Trust results came in very bad, which is expected. I mentioned in my previous video that with a decent amount of their assets in China and Hong Kong, this brings about risk for both REITs because these properties will not do well. MIT was the only one that was doing decent out of the three. Mapletree Logistics Trust announced their recent results with DPU dropping 2% quarter over quarter and 10.6% year over year to 2.027 cents. MPACT announced their results with a 11.6% drop in DPU year over year, which is bad as well. MIT was the better one of the three, with DPU increasing 1.5% year over year, but negative 1.7% quarter over quarter. As a dividend stock, it's never good to have a drop in DPU because this means that at the current share price, the dividend yield of the stock will drop. Both MLT and MPACT have in common where their Singapore properties are performing well, while China and Hong Kong properties are performing very badly. So let us get right into their individual results. Mapletree Logistics Trust is a REIT which owns purely logistic properties and it is an in-demand property class. However, the problem with MLT now is that two of their three largest assets in the countries are not doing well. They are essentially Hong Kong at 22.4% and China at 18.4%. For REITs, the important factor that determines the REIT's organic revenue growth is rental reversions. Rental reversions is a metric which shows whether new leases signed have a lower or higher rental rates than before. If we see the slides, Singapore's rental reversion came in at 12.5%, which is very good. However, the rest of the other properties in other countries are not doing so well, with only Vietnam and India at 4.1%. The rest of the properties in other countries are doing below inflation rate, but the highlight is China at negative 12.2%, while Hong Kong is just 1.2%. Why I focus on China and Hong Kong is because more of their assets are in these respective countries. Now that we have seen the rental reversion rates, the number of leases expiring is also important. For countries that have good rental reversion rates, it's good to have leases expiring as they are renewed at a higher rate. This will bring about higher income for the REITs. However, it's the opposite for rental reversions that are in the negative range. Unfortunately for MLT, leases expiring of Singapore properties is only at 2.3%, while the leases expiring in China is at 6.8%. So assuming the same performance as this quarter, there will be a positive 12% rentals for 2.3% of the leases in Singapore properties versus negative 12% negative rentals from 6.8% of the leases from the China properties. So looking at these two, what would you expect the revenue for MLT to be? Moreover, in the next 2 years, China will have even more leases that needs to be renewed. The biggest risk for MLT now is that if the China leases continue to perform badly, MLT dividends will be expected to continue dropping. With the overseas properties, especially China leases, not doing well, this led to bad results for MLT. Revenue and net property income both dropped year over year. Even though property expenses shows 0%, it did increase because the expense cost for this quarter is for 186 properties compared to the 189 properties in the financial year of 23 and 24. Borrowing costs increased 8.2%, therefore with revenues dropping and expenses increasing, this led to lower distributable income of 8% and DPU of negative 10.6%. The drop in DPU is also contributed from the increase in the issued units and more monies given to perpetual security holders. MLT's share units are increasing because of the DRP program plan that has been happening for the past few quarters. It's common for REITs to do this, which encourages shareholders to take up MLT shares as dividends instead of cash. But shareholders who do not take up this plan will be at a loss as their shares will slowly be diluted, which can lead to lower dividend like this case. The management have also included DPU, excluding the money they have distributed from the gains of divesting some of their properties. It would have only been 1.907 cents instead of the 2.027 cents reported this quarter. As an investor, it's important to forecast how much DPU increase or decrease you expect the REITs to give. With the divestment of their properties and taking out additional loans, their leverage ratio has increased to 40.2%. Even though their current average debt payment interest is only at 2.7%, it's not always a good thing. With debts required to be refinanced in the next few years, MLT might see their cost of debt tick up once refinancing is required. So this is another thing that you have to prepare for when investing in MLT. Next, MPACT is the other Mapletree REIT that is similar to MLT when it comes to experiencing drop in dividend. MPACT is a retail and commercial REIT as compared to MLT, which is a logistic REIT, but they have one thing in common. Their assets in China and Hong Kong is quite a large amount. This is why MPACT is also suffering in terms of performance. VivoCity and Festive Walk are two very important assets for MPACT because they contribute half of MPACT's overall income. Like I mentioned previously, retail properties' important bread and butter metrics are their tenant sales and shopper traffics. If you look at VivoCity, both are continuing to drop, which is not good because I mentioned about the post-COVID slowdown in spending with locals traveling overseas. The performance for Festive Walk is very interesting. Even though shopper traffics increased by 1.3%, tenant sales dropped drastically by 13.2% year over year. So even though there's more people going to the malls, sales in the shops are dropping. This is very bad because lower tenant sales might discourage tenants from continuing to lease. This led to the negative rental reversions for Festive Walk at negative 6.1% for 38 lease for this financial year. If things do not improve, this will definitely continue to impact MPACTs with lower lease renewals. On the bright side, VivoCity is still performing well with 17.3% positive rental reversions for 85 leases, as it is a very good shopping mall, while the other SG properties are still performing decent. Similar to last quarter, all of the other overseas properties are performing badly with negative rental reversions in Japan and China as well. Korea has experienced a negative 27.3% rental reversion, but is a small item as it accounts for just a small amount of MPACT assets. So these assets should not be concerned to us as investors. If we look at the committed occupancy, one thing to notice is that occupancy for Japan properties has dropped drastically from 94.2% to 82.3%. As Japan properties accounts for 9% of MPACT's overall assets, it's definitely not good. Moreover, they have another tenant that is not going to renew their leases expiring at March 2026. This will expect the income from Japan to continue coming down. This again shows how overseas commercial properties are still weakening, which is never a good thing for overseas commercial REITs. This led to terrible results across the board. Revenue and MPI dropped at 6.1% and 8.5% year over year. Properties expenses also increased 1.7%, and the only good value is that their finance expense dropped 2.6% year over year. This led to lower distributable income of 11.9%, while DPU dropped by 11.6%. Previously, they have sold Mapletree Anson's divestment for the loans payment, which led to 6.8% drop in revenue. However, finance costs only improved by 2.6% because the Singapore, Hong Kong and Japan loans interests are still increasing. This is not good. With more loans that needs to be refinanced in the next few years, their finance costs might continue to increase. Even though their leverage ratio has dropped from 40.5% to 38.4%, their finance cost is still ticking up from the refinancing from 3.54% to 3.56%. Therefore, I suspect their finance costs will continue to increase once these debts needs to be refinanced. Overall, What is the main issue that MLT and MPACT is facing that is causing their REITs dividend to drop? The main issue is the leases in China and Hong Kong expiring with rental reversions coming in negative. As long as the situation in Hong Kong and China do not improve for both REITs, I feel that there might be more pain to come for their dividends as the leases gets renewed. With interest rate coming down, the safe yield from different assets will drop. For those with ideal cash that wants a higher yield, Momo Cash Plus is definitely a place you can consider putting your money in. This also supports my channel by using my link. It guarantees up to 6.8% yield for the first 30 days. That is higher than some of the dividend equity in Singapore and not bad for a short-term return. These funds can also be redeemed with no lock-in periods. Existing users will also get to enjoy the promo by putting in fresh funds of at least $10,000 and maintaining it for at least 60 days. For new users to Momo, there is also a starter promo kit for you. By depositing $100 and making just one buy trade, you will get $20 cash coupon. Similarly, if you deposit $3,000 with 3 trades, you will get stock bundles worth $70 with fractional shares from stocks such as Apple, Nvidia, Tesla, AMD or Microsoft. Making $10,000 deposit with 8 trades will get you $210. So let's start your investment journey with Momo and sign up with my link today. MIT is also another REIT that have recently announced their results. MIT is not as bad as MPACT or MLT as their dividends did not drop that much. Although the dividends increased 1.5% year over year, its dividend actually dropped 1.7% quarter over quarter. It is quite disappointing considering the fact that they have Osaka data centers to boost their revenue. So we can see that the distributable income has dropped slightly from 96.4 million to 97.9 million. If we compare the quarter over quarter results, revenue and MPI is up 3.5% and 1.5% respectively thanks to the Japan data centers. However, property expenses went up significantly by 9.8% while borrowing costs also surprisingly came in higher at 3.4%. Because of the larger increase in the expenses, this led to a disappointing drop of their dividends to 3.37 cents from 3.43 cents of last quarter. One of the things to focus on is their higher interest costs from non-replacement of interest rate hedges. If we see their debt maturity profile, as the interest rate might not come down that quickly, their debts that needs to be refinanced for next financial year might be a concern as they have to refinance this large amount of debts. This is something that we have to be looked into for the next few quarters. My concern is that with the interest rate still high, the refinancing of these debts might increase MIT's borrowing costs and will risk dividends dropping if the growth of revenue from the properties are not able to offset it. For MIT, rental reversions had a mix of results with renewal leases for high-tech buildings coming in higher but lower for the new leases. Opposite is true for their business park buildings. Unfortunately, there is no data regarding the data center leases. On the bright side, MIT has continued making the right action by purchasing more data center assets. They have bought another DC in Tokyo, which will definitely increase their revenue and income. In the long term, MIT should do well as they expand their assets into data centers. However, short-term, refinancing of their debts in this level of interest rate environment might be a problem for them, which might pull down their dividends. Overall, even though all 3 REITs experienced drop in dividend, MIT currently is the better performer because of the different property classes and they do not have assets in Hong Kong and China. Thank you so much for watching. I hope you enjoyed this video. Please support the channel by hitting the like, subscribe and comment on what you feel about the 3 Mapletree REITs results. As we go through the earnings seasons, more exciting results are coming out and Singapore banks are definitely one of them. Thank you so much for watching and I'll see you in the next video.